What if the price collapse you're watching isn't a warning but a distraction? What if the red candles on gold and silver charts are designed to trigger fear, not to reflect reality? That is exactly what unfolded at the end of January 2026. Gold and silver prices fell sharply on US screens, but not because real demand weakened. Silver dropped from above $120 to below $90 in less than 24 hours, a move of more than 25%. Gold lost hundreds of dollars in the same session. Mainstream headlines called it a sell-off. But the structure of the market tells a different story. These prices are set in the paper futures market, where enormous volumes of contracts can be sold instantly without delivering a single ounce of metal. On days like January 30, billions of dollars worth of paper claims were dumped within hours, overwhelming price discovery by design. Here is the contradiction. When prices truly reflect falling demand, buyers disappear. In late January, they did not. Physical markets showed the opposite behavior. Delivery notices surged, vault inventories tightened, and large holders chose to stand for metal instead of rolling paper contracts. This means real buyers were willing to take gold and silver off the exchange even as prices were crashing on screen. That is not fear, that is conviction. The problem is psychological. Most investors experience the market through charts, not ledgers. They see falling prices and assume value is evaporating. In reality, the chart has become a puppet show, fast, emotional, and easy to manipulate, while the real stress is building quietly in the physical market behind it. When paper prices fall but physical demand strengthens, the price is not revealing truth, it is hiding it. Before we analyze the real causes behind this sell-off, welcome to GE Economy, a channel dedicated to in-depth analysis of economics, finance, and market cycles. If you find this perspective valuable, don't forget to like the video to support the channel and subscribe to receive more insights like this. If the price collapse in late January was not driven by real weakness, then the next question becomes unavoidable. Why did it happen at that exact moment? Timing, in this case, is not a coincidence, it is the evidence. The smash occurred at one of the most sensitive windows in the futures calendar, the end of the week, the end of the month, and just days before first notice day for February contracts. On Friday, the 30th of January 2026, liquidity was thin, risk desks were defensive, and books were about to be marked for regulatory reporting. This is precisely when paper markets are most vulnerable to large, concentrated selling. By dumping a heavy volume of futures contracts into a quiet market, prices can be pushed sharply lower with minimal resistance. That is exactly what happened. The first objective was behavioral. Right before first notice day, contract holders must choose whether to roll their position forward or stand for physical delivery. A violent price drop is meant to scare longs into rolling. Falling prices create the illusion of a bad trade, nudging investors to stay in paper rather than demand metal. Historically, this tactic works because most participants prefer avoiding volatility over challenging the system. The second objective was accounting. Bullion banks carry massive short exposure in precious metals. If silver closes the month at $120 instead of $90, the difference represents billions of dollars in unrealized losses. By forcing prices lower, if only for the monthly close, banks can mark their positions at friendlier levels. Capital ratios improve, risk metrics calm down, regulators see stability instead of stress. In short, the sell-off was not about value changing, it was about managing behavior and balance sheets at the most strategically advantageous moment on the calendar. If the price smash was meant to frighten investors out of the market, the data from first notice day delivered a devastating rebuttal. Instead of retreating, demand for physical gold exploded. On the very first day of the February 2026 delivery window, 20,484 gold contracts stood for delivery. Each COMEX gold contract represents 100 troy ounces. That means buyers demanded 2,048,400 ounces of gold, or roughly 63 metric tons, in a single session. For context, that volume rivals the monthly gold purchases of some central banks, and it occurred during a sharp price decline. This is where the futures narrative completely breaks down. Under normal conditions, only a small fraction of contracts stand for delivery. Most are rolled forward or closed out in cash. Typical first notice day delivery volume ranges between 2,000 and 3,000 contracts. A figure above 20,000 is not merely unusual, it is statistically extreme. In market terms, it qualifies as a 10 sigma event, something that should not happen under a functioning paper market designed to discourage physical settlement. The timing makes the contradiction even sharper. These delivery notices were issued while prices were falling, not rising. In a healthy market, falling prices signal weak demand. Here, they coincided with one of the largest delivery demands on record. That tells us the price was not signaling reality, It was being used as a tool. Buyers ignored the screen and focused on the contract terms. They chose metal over paper. This surge in delivery demand is clear evidence that the futures mechanism built to keep gold trading as a financial abstraction failed at a critical moment. When participants stop rolling and start demanding bars, the illusion breaks. And once that happens, price loses its authority. The delivery surge becomes even more revealing once we examine who was actually on each side of the trade. The data from First Notice Day shows a pattern that cannot be explained by normal market behavior. JP Morgan, the single most influential bullion bank in the gold market, was simultaneously one of the largest sellers and one of the largest buyers of physical gold. On paper, JP Morgan issued approximately 11,900 delivery notices, meaning it delivered close to 1.19 million ounces of gold. At the same time, another arm of the same institution stopped or took delivery on roughly 8,000 contracts, equivalent to 800,000 ounces. This is not hedging in the traditional sense. It is internal churn. Gold is being shuffled between desks, accounts, and clients inside the same institution, creating the illusion of balanced market activity while masking a net outflow of metal. When the dust settles, JP Morgan still lost roughly 3,900 contracts, or nearly 12 metric tons of gold. In a market already facing tight physical supply, that is not noise, it is stress. The pattern extends beyond the United States. European banks were also forced to deliver significant quantities of metal. Deutsche Bank issued around 2,387 delivery notices, while UBS issued approximately 2,379. These are not speculative players. They are custodians of European gold liquidity. Their presence on the delivery side indicates that metal is being pulled out of Western vaults, not recycled within them. Together, this behavior reveals a market trying to conceal a physical drain. Paper activity is being used as camouflage, while real gold quietly changes hands. The churn is not evidence of stability, it is evidence of strain. If gold exposed stress inside the future system, silver revealed something far more disturbing, a market where the price collapsed, but access disappeared. In the 24 hours leading into the 30th of January, 2026, silver was driven from roughly $120 per ounce to below $90, a drop of more than 25% in a single session. On paper, it looked like a classic capitulation. In reality, it was a controlled demolition. Under normal conditions, a move of that magnitude would trigger aggressive bargain hunting. If investors liked silver at $120, demand at $90 should have been overwhelming. But when the price hit those levels, something unprecedented happened. Major retail bullion dealers abruptly went offline. Websites showed error messages or scheduled maintenance notices precisely at the moment volatility peaked. At the same time, reports from London indicated disruptions in electronic matching and settlement systems linked to the London Bullion Market Association. This effectively cut off one of the largest channels through which physical silver is normally arbitraged and redistributed. This was not a coincidence, and it was not a technical glitch. Maintenance windows are planned weeks in advance. Systems do not fail simultaneously across regions by accident. What occurred was a lockout, a deliberate shutdown of access when prices became too attractive. By removing the buy button, dealers prevented a surge of physical demand that would have instantly drained inventories. With buyers sidelined, the order book was left thin, allowing the paper price to fall freely into a vacuum. The objective was simple: stop metal from leaving the system. Low prices encourage delivery and hoarding, especially in silver, where inventories are already tight. By blocking purchases during the crash, the market's most powerful participants bought time. But the cost of that maneuver is credibility. A price that exists only when you are not allowed to act on it is not a real price. It is a signal, one that points to fear, not abundance, inside the physical silver market. The lockout in silver was compounded by a quieter but equally damaging problem: a sudden liquidity freeze in the physical retail market, especially in so-called junk silver. In the final days of January 2026, major refineries across North America quietly changed their intake policies. Overwhelmed by industrial demand and large bar orders, they announced they would temporarily accept only high-purity silver, typically 999 fine, while refusing 90% coinage silver, the pre-1965 dimes, quarters, and half dollars that normally anchor retail trading. The impact was immediate. Local coin shops, which had spent weeks buying junk silver from the public, suddenly found themselves stuck with inventory they could not move upstream. Wholesalers would not buy it, because refiners would not melt it. With cash tied up in unsellable metal, many shops simply ran out of liquidity. When a dealer has no cash, the bid disappears not because silver has lost value, but because the plumbing is clogged. For retail holders, this created the illusion that demand had collapsed. In reality, the market had seized up. Physical silver was still wanted, but it could not flow through the system fast enough to clear transactions. This is a classic liquidity trap. Sellers cannot sell, buyers cannot buy, and price signals break down. In such conditions, falling prices do not indicate weakness. They indicate stress. The junk silver bottleneck did not expose a lack of demand. It exposed a system struggling to process it. While retail buyers were locked out and local dealers were starved of liquidity, a very different class of participants stepped in quietly. Large private buyers' whales, family offices, and Asian trading houses do not rely on retail websites or posted spot prices. They buy directly from refiners, wholesalers, and vault operators, often in truckload quantities. For them, a paper crash is not a signal to retreat, it is an invitation to negotiate. By the last week of January 2026, this divergence became visible in regional pricing. While silver briefly traded near $90 per ounce in New York, physical quotes in Asia remained materially higher. In particular, China continued to absorb metal at prices well above Western benchmarks, reflecting tight inventories and sustained industrial and investment demand. This price gap created a powerful arbitrage incentive. Every ounce acquired cheaply in the United States or Europe could be shipped east at an immediate premium. Crucially, these buyers were not constrained by temporary lockouts or cash shortages. They did not need a buy button. Contracts were settled offline, volumes were aggregated, and metal moved directly from Western vaults to Asian destinations. The result was a silent drain. As Western investors focused on falling charts, physical silver was leaving the system. This is the defining asymmetry of the moment: panic selling in the West, strategic accumulation in the East. And once that metal moves, it does not come back. Just as revealing as who was buying silver was who refused to bet against it. In a normal market, a violent price collapse triggers an immediate response from speculators. Hedge funds pile into short positions, momentum traders press the downside, and borrow fees spike as everyone races to profit from falling prices. In late January 2026, that did not happen. Despite silver's drop of more than 25% in a single day, the cost to borrow shares of the largest silver ETF remained exceptionally low. Borrow fees hovered near 0.5%, a level typically seen in calm, liquid markets, not during a historic crash. Even more striking, millions of shares were available to borrow, yet demand to short them was minimal. Hedge funds are not constrained by emotion or loyalty to the metal. If they believed the price collapse reflected real weakness, they would have attacked aggressively. They did not because they saw the same contradiction the physical market was signaling: low paper prices paired with persistent global demand. To short silver at depressed levels while metal was flowing east and inventories were tightening would be to stand in front of a known risk. The implication is uncomfortable. If speculators were not driving the sell-off, then the selling pressure came from a far narrower source. The evidence points to a small number of bullion banks, unloading paper positions to manage balance sheets and cap prices alone. When only forced sellers remain and opportunistic shorts stay away, price no longer reflects consensus. It reflects stress. And stress, in markets like this, tends to resolve suddenly and violently in the opposite direction. The contradiction becomes impossible to ignore once we look at what the banks are doing versus what they are saying. On trading screens in late January 2026, gold was aggressively sold, pushed hundreds of dollars lower through concentrated paper activity. Yet almost simultaneously, a research note circulated from JP Morgan projecting a long-term gold price near $8,500 per ounce, roughly 60% above prevailing levels at the time. These two actions are not inconsistent, they are complementary. The trading desk operates in the present. Its mandate is to manage risk, suppress volatility, and protect balance sheets day to day. When gold threatens to break higher at month end, dumping futures contracts can force prices lower long enough to relieve pressure. But the research desk operates on a different horizon. It speaks to institutional clients, pension funds, and sovereign allocators about where capital is likely to flow over years, not days. Their bullish forecast is rooted in structural forces: rising gold allocation from private investors, persistent currency debasement, and declining confidence in sovereign debt. Put simply, the bank believes gold is going much higher, but not before they finish positioning. Smashing the price serves a purpose. It shakes out weak hands, triggers stop losses, and convinces retail holders that the move is over. Every panic sale creates liquidity, and liquidity is exactly what large institutions need to accumulate metal quietly at lower prices. This is the classic shake the tree strategy. Force the price down to see who lets go. When a bank sells aggressively while forecasting much higher prices, It is not confused. It is patient. The message is clear. The short-term pain is tactical. The long-term conviction remains firmly bullish. By the end of January 2026, the consequences of these distortions became unmistakable. The precious metals market fractured into three separate prices, each telling a different story. The first is the New York paper price, the number flashing on futures screens. This is the lowest price, shaped by leveraged contracts and algorithmic selling. It is liquid in theory, but increasingly illiquid in practice. At these levels, large-scale physical delivery is difficult or impossible. The price exists, but the metal does not reliably follow. The second layer is the international transaction price, visible in physical hubs like London and Mumbai. Here, gold and silver continue to change hands between refiners, bullion banks, and industrial users at higher levels than New York quotes suggest. This price reflects actual settlement, logistics, and availability. It is slower, less visible, but far more grounded in reality. The third and most revealing layer is the China price. In China, physical metal commands a persistent premium. This is not speculation, it is a floor set by necessity. Inventories are tight, industrial demand is steady, and strategic accumulation remains active. Metal purchased at discounted Western prices is quickly absorbed and does not re-enter global circulation. This three-tier system exposes the cost of selling based on paper signals. Investors who exit at the New York price are not just taking a loss, they are transferring real, finite assets to buyers operating in higher-priced physical markets. The spread between these prices is not inefficiency. It is a warning. When one asset trades at three values simultaneously, the lowest one does not represent value. It represents opportunity for whoever can take delivery. What you see on the screen no longer reflects supply and demand, it reflects stress, incentives, and control. In this environment, low prices are not a sell signal. They are a psychological weapon, deployed to force weak hands out of real assets. Those who panic are not just losing money in the short term, they are transferring scarce, physical wealth to stronger buyers who understand the game. Thank you for watching. If this analysis helped clarify the bigger picture, share your perspective in the comments.